So we are here in the last session, all that stands between you and lunch today, and we want to talk about analysis, best practices and accreditation suggestions, and also coming to cover some of the differences between these two things. So there are three of us at the table. I'm over here, and I would like to go through and have everybody introduce themselves. We'll start with Sarah Franson.
Hi, good morning, everyone. Yeah, still morning. I'm Sarah Franson with the accreditation program. I've been at the NAIC now for 23 years. So, as I said yesterday, I think that 23 is an important number for Michael Jordan, one of the greatest of all time. So I feel like my 23rd year at the NAIC should be one of the greatest of all times as well, which also might be why we kicked it off with Taylor Swift today, or maybe because that's my guilty pleasure. So.
My introduction won't be that interesting. My name is Michelle Lowe. I'm the Chief Analyst at the Department of Insurance, California, of course. My team oversees actually the financial conditions of over 1,300 licensed insurers and other non-insurance entities. And also my team, they are responsible for the financial review of the, let's say, admission applications, merger acquisitions, holding company transactions, and of course, a special project, a supervisor college, you can name them. All right, I'll pass that on to Ed.
Thank you, Michelle. It's good to see a lot of faces in here. The last program of the day, we'll try to make it worth your while. My name's Ed Dinkle. I've been in my accreditation era since 1990 when I joined the accreditation program at the NAIC, and have spent the last, 30-ish years, kind of hard to say, doing accreditations through the NAIC, and I became a contractor later and have continued in the accreditation program. So most of you probably have seen me in your states since I've been to all 50 states, so it's good to see you. Thanks.
And finally, I'm the junior-most member up here. I'm Topher Hughes. I'm part of the accreditation team at NAIC as one of the observers, but also more relevantly for this presentation, I run the peer review program for analysis and exam, including the various flavors when we do ORSAS, for instance. So we're going to be talking about these programs. So what do we want you guys to get from today? One thing we want you to be able to do is to kind of say, all right, so what are some of the more recent sound practices that have come up? What have we learned in the past year or so? And how can we maybe apply this to our own work? We want you to be able to look at those that we put out and promulgate and say, is that useful for us, or is this just not going to fit within our model? How can we evaluate those and decide if it's going to work for you? There's also some myths and some misunderstandings, and we want to address some of those. It is very common for the accreditation team to come out and then come back and say, well, yeah, we got told that peer review said, or, well, oh, yeah, we're doing this because the accreditation team said. So we want to address a few of those. And then finally, we want you to understand how some of these sound practices might differ from the actual accreditation standards, right? These are not the same things, so we want you to be able to cover these sorts of things. All right.
All right, so we are first going to, over the next few slides, I think we're going to be covering a variety of different maybe best practices or things to follow. But really they all stem, if we're going to tie this into accreditation and how that kind of ties together or how it might or might not, it really focuses really on the appropriate depth and quality of review, which if you all are familiar with the accreditation program, we have what are called review team guidelines, which is essentially the Bible for accreditation team members. So if you're ever wanting to know exactly what the review team members are going to be looking at, it is not a secret. It's all maintained inside the accreditation program manual under the review team guidelines. So literally that's what they follow. The biggest chunk of analysis when the teams are assessing a state's compliance with the standards really focuses on the appropriate depth and quality of review. And really we're looking at analysis itself is the work that's produced of high quality. Are you noticing the significant fluctuations, prospective risks that could potentially impact financial solvency of a company? It really kind of encompasses everything about the process of analysis. It's an art, I guess you could say. It's kind of hard to exactly explain, but I mean, it covers everything from how well the IPS is written to the actual underlying analysis that may be contained within the risk assessment worksheet, how you're handling the group profile summaries, how you're handling even just all the different intricacies of a company itself and how you're addressing them and bringing those issues forward. And so that's kind of what these next few topics that we'll be covering kind of really focus on and touch on indirectly and probably in most ways is just that appropriate depth and quality of review.
All right, so we've had you here trapped now for 5 minutes. For CE purposes, you are now thoroughly stuck in this room. So this is the point where I'm going to ask you to do your first interaction, and we're going to ask several of these of you. How many people in here, and this will be a raise your hand thing, are analysts? Okay, and how many of you supervise other analysts? All right, so probably about 2/3 analysts, maybe about half supervising. So one of the things that we want to get across in terms of recent best practices, and something that, I think the accreditation team has also encouraged, and we'll find out as we go here how much I'm off base on, is that customization is absolutely king, right? When we look through an IPS and we see a risk of bonds, that doesn't tell me very much, right? That doesn't help anyone who has to quickly glance through that IPS to understand what the risk is. On the other hand, if we look through and we see that there is a risk of excessively high concentration in financial I&M bonds, that becomes really interesting, right? Because even without necessarily reading the text, all of a sudden we have a better idea of what we might be facing. And so what we're going to do as we go through most of these slides is I'm going to turn it over to my colleagues over here and ask them questions. So in this case, we're going to start with Michelle. And Michelle, when you were supervising analysts and when you're looking at your analysts in your department, how do they do with customization? How do you encourage this?
Here. That might help. I think customization is very important because that specificity adds clarity and relevance, right? So we always encourage our analysts, based on their own knowledge of the company and exercise their independent judgment. Don't just based on the risk repositories or annual statement line items to customize their risk, because that's not customization. You only see, not all the companies are the same. Not all the analysts are the same. So I want to see all the analyses are somewhat different and reflect the unique risk of their companies. Yeah. I think for customization that shows the analysts their familiarity, their clear understanding of their companies, the underlying issues, and also the risk they customize can help indicate the risk components to better describe the risks and also reflect their most current assessment. It also helps them to prepare their follow-up plans, make it more relevant, and that will also help the department take timely regulatory actions, right? Because customized is very unique and relevant, target the issues. Yeah, thank you.
Thank you very much. And Ed, as our representative team member from the accreditation team, what does the accreditation team think of customization of risks?
No comment. No, seriously. When I was preparing some of my work, I didn't know where we were in the order of the training sessions, and this morning I sat through the Bermuda reinsurance and the cat risk, and that's exactly the example I have. And the accreditation team, it's an important part of our assessment. We're assessed with understanding the knowledge of the analysts. with the quality of their work and their supervisory plans. And one important aspect of that is customization of risks. And the example I wrote down is, and these are all examples I give you today of things I've seen. It's not unusual that catastrophe risk is not its own individual risk. And that it always surprises me that it's not, because it impacts so many things. So for instance, this morning in the Bermuda discussion, John Huff mentioned liquidity. And liquidity is such a big part of CATs. You know, is the primary insurer able to have the liquidity necessary to handle a catastrophe? And so that's one aspect of it where customization in liquidity is an important piece. But it goes beyond that. So operationally, CAT risk is a big issue. So in that regard, so what if a CAT happens? Do you have the staff? Do you have adjusters? Do you have the systems that can handle that catastrophe? I had a company that I reviewed. They told us, hey, we got all these adjusters just in all these states, just in case a CAT happens. We have them on contract. And I asked them, well, how many other insurance companies are they contracted with? I had no idea. And because what we've seen, like, for instance, I recall one happening in Oklahoma, and the commissioner at the time said, yeah, there were all supposed to be all these adjusters, but they're all working for the same, for every insurance company, so we couldn't get our claims adjusted quickly. So that's a big one. And of course, strategic is a big part of that. But why it's so important is something Michelle commented on. It directs your work. So if you use just a big, what's the bond portfolio, as you said, it can, you just maybe look at the big picture, but by looking at the individual risks, customizing them, it then drives your underlying supervisory plan, which is a big part of what we look at, is how you're carrying out the risk, how you're overseeing those risks. So,
Excellent, thank you. One of the other things that we've recently kind of suggested is, don't be an AI. And what do we mean by this? Right? Any, half-competent computer program going back now 15, 20 years can look at financials and tell us this value is this. The combined ratio is 98. Doesn't tell us necessarily what it means. Recently, ChatGPT might be able to say, and the combined ratio looks at these things, but that still doesn't tell us what that means for this company, right? So in this case, we want analysts, right? This is the bread and butter. This is where you have your job security. We want to know about how and why these things are important to this specific company that you're writing about, right? A combined ratio of 98 might be terrible for a company, while another one might have a combined ratio of 110, and you're looking at going, oh, wow, they've done so much better, right? Even if they're not necessarily profitable at the moment, they're definitely doing a lot better here. So in this case, Ed, we're going to come back to you first, and then we'll come to Michelle after you, is when you were looking through analyses for accreditation, what do you look for in terms of the quality and the type of work that you're seeing?
yeah, so we're very spoiled as analysts in that the NAIC has done such a great job of putting qualitative stuff in front of us. All the ratios, all the data that we have that we put in front of an analyst. But that only tells a small part of the story. That actually just directs us to the issues, not necessarily by answering, okay, this went up, this went down. We're in a modern risk-focused surveillance system. That's what we're trying to do. So what's the risk? Yeah, you answered the question. So here's one that I see quite a bit when I'm out on reviews is a company might get into a new line of business. And so when they get into the operational or the underwriting risks, the repositories trigger that maybe this line of business jumped by more than whatever the trigger is. And in their operational risk write-up, they're like, oh yeah, I know what that is. They started to write workers' comp. And I said, and so? And then they just look at you. And that's where qualitative comes in, and that's really where the beef of it is. We as team members look at process-oriented guidelines. Sarah brought up the guidelines, process-oriented guidelines, and or results-oriented guidelines. And it's really the result-oriented guidelines that we really focus on. So the others are mainly just checklist items. Did you do, did you do, did you do? It's more, okay, so they're writing workers' comp. Do they have the people, the underwriters they need? Do they have the systems do they need? How about pricing? Did they have to file any kind of rates? Do they use NCCI? Those kind of things. Did you get with your product people? What do we know? Is it? And so then you can, again, it builds your risk profile for you and your work that follows. So it's a big part of what we look at.
Thanks. And Michelle, how about you? How do you as a regulator view this issue?
I think it's very critical for our analysts to do more in-depth and thorough analysis. Again, the example I have, for example, just the agent's balance. Our analysts will disclose, the company has a large increasing agent's balances, and that's about it, increasing. I can tell that from the company profile. I don't need that right up, right? So the question is more, why it keep growing? Was it because the rapid growth, or because they're using MGA? They did not have strict underwriting guidelines, and whether the underwriting agreements have been approved by the department. What kind of oversight does the insurer have, over their MGAs, whether that's affiliated or not affiliated, and do they have a trust account, set up for this? And the more questions we ask, actually, we discover more issues. It turned out one of the insurers, the trust account is auto trust, so there's no money there. And that actually caused the conservation eventually of that insurer. Another example can be when our analysts talk about, hey, the parent has a capital maintenance agreement. But again, they should ask the question whether the same parent has similar arrangements with all the other insurers, right? Does the parent company has sufficient capital to support every single one of them when the entire group is experiencing challenges? Yeah. So.
Thank you. I am going to go back one moment here. And
Just
let
real
my
quick,
colleague-
I think they've provided amazing examples. I think Ed kind of alluded to before, the NEIC is great at giving us the quantitative data, and what it is the analysts need to basically tell the story like they've been saying up here. It's one of the things we've always kind of encouraged them. The standard itself is, yes, you're supposed to identify those significant fluctuations, and I think everyone's extremely well-versed at doing that. We definitely see that this line went up or this line went down, but as Michelle said, you really have to investigate and assess as to why that happened, and that's where we sometimes see that disconnect where we're always really trying to push, and that's why a lot of the questions that the team members will ask of the states kind of centers around just trying to get your understanding of why did that matter, how could that impact the company, and just keep looking further and further and kind of step away and look at the bigger picture.
Thanks. Now, this is one where I know that there is a disagreement between Ed and I, so I'm going to turn to Ed first on this one. But one of the best practices that have come out of peer review is that not every risk should make it to the IPS, right? And the example that I choose, and I'm going to choose this one again deliberately because this is the one that Ed and I argued over, is that, for instance, if a company's holdings are, you have a huge amount of bonds and they're all U.S. Treasuries, there's probably not a credit risk there. And, it's such a low-level risk that maybe that doesn't need to be on the IPS. And Ed, I'm going to turn to you first on this one because I know we did disagree about what should and should not necessarily be on the IPS.
No comment. When team, and particularly me, when I go into states and I provide some comments on the IPS, I'm sure the analysts are looking at me and saying, you know, haters are going to hate. But I always tell them, shake it off, shake it off. That's what I tell them. So.
I've trained my team members well, just saying.
So anyway, no, it's a difficult one because, you know, I'm going to ask questions. Almost everybody here is an analyst. I saw that when we raised our hands. And so from those same analysts, I want you to raise your hand if you think as everybody knows, the accreditation program is of multi-state companies. We don't look at single-state companies. So for single-state companies, I want you to raise your hand if you think for accreditation, you have to prepare an IPS for all companies that are multi-state. Raise your hand if you think yes. Okay?
So let the record show that was 10% of the room.
Yeah, 10% of you think that. How many of you think for every company, the multi-state company, we need to prepare a risk assessment worksheet on the annual? Okay?
A much smaller percentage.
Okay. And how many of you think that for every company, for every multi-state company, we need to prepare the supplemental checklists, like for the MD&A, the CPA audit?
One poor person gave Ed some company there.
Okay. So the answer to that is just one of them. You know which one that is? The IPS. So if you have a priority 4 company, you don't have to do the raw. And for none of the companies do you have to prepare the supplemental checklists. Okay? You don't have to. Now it's encouraged, and this is something we'll get to later, like the myths. You know, you hear the team members say something, and you know your own department says things, and we can talk about that. So the IPS has become the preeminent document prepared by the analysts. And so for an accreditation team member, but so you all know, I do this too. I'm a supervisor in some states on a contract basis, so I do this too. And so when I look at an IPS, I think it should tell the story, the risk profile, like it should support the risk profile. The heat map should support the priority. The conclusion should support both. And if it doesn't give me that story and give me an accurate and complete story, I don't think it's done. Now, when people hear this, they think, oh, Ed wants a 20-page IPS. It's not what I want at all. I just want something that's complete. It can be very concise, but complete. So how many of you know of a company in your state where the bond portfolio is not the largest asset group on the balance sheet? One? Okay? One instant. So you have your most material asset, your bond portfolio, and you're not going to put anything on the IPS. Think about that for a minute. Your most material asset doesn't have credit risk? Really? Of course it does. Because really what's underlying that, the risk is really in the investment, the company's ability to invest in other things. So they could invest all in U.S. Treasuries, but maybe their board has given them the ability to invest in CLOs, they can invest in equities, they can invest, and maybe have really limited investment limitations. And because of that, there's a lot of risk there. There's a lot of inherent risk in their investments. Now, they've mitigated that risk by putting everything in U.S. Treasuries. So, high inherent risk, low residual risk. So as I interpret the analysis handbook, those are scenarios that need to be on the IPS. Now, do you need to have a big 6-paragraph thing explaining U.S. Treasuries? Part of them are 2 to 5 years, the rest are 6 to 8 years. No. What I'm saying is maybe even just a short, the company invests entirely in U.S. Treasuries, thus the credit risk is low. And so I think that gives the reader a better picture of the overall risk profile of the company. Without that, if you just put no material credit risks, if I'm another state getting your IPS, guess what I'm doing? I'm going to their investment portfolio and seeing what's there, because you haven't told me anything. So that's why the difference. That's the NAIC guidance provide that if you have a higher moderate risk to start with and you get down to minimal, then you should include those risks in the IPS. I find it interesting many times when an analyst will include non-investment grade bonds, and they're like, okay, it's like 5% of the, 5% of capital surplus. So they triggered. I said, so what happens if 5% of their surplus goes away? What's their RBC? Well, it'll be 1,566. Really? So you're putting that on there, but you're not putting your whole bond portfolio. So that's where I come from.
Thank you, Ed. And as you can
That's
see,
long, and I'm sorry, I'm cutting in everybody's time.
there are definitely some shades of gray in here where those disagreements occur. So Michelle, for you, how do you encourage your regulators to decide what goes onto the IPS and what remains in the raw?
Sure. The IPS, to me, is a communication tool because we don't offer raw to other regulators, so IPS is very important. That it really needs to summarize our key concerns or the key action plans, supervisory plans, right? So for moderate and significant risk, I will ask our analysts to, you need to describe, show the work that you did, and the major concerns, also the trend, going up or down, and also what's your follow-up procedures. Don't just say up and down, or I have a concern. So there's a concern, but what? What did you do with your concern? What's next? For minimal concern, minimal risk, Ed already explained, right? You need to keep it short, brief, but you need to describe how your mitigation factors, why the issue, the risk becomes smaller or minimal. And for the non-significant or no issue, no concern, those type of risk, don't bring over. Keep it in the raw. Okay, LPS is supposed to be really a focused summary. So avoid bringing over too much detail, make the reader, difficult to look for your key issues. Make the most significant issues stand out, easier for them to see. And also, don't eliminate too much either, because that defeats the purpose of having that communication tool.
Thank you. All right, so for the people at home, this is a Slido question time frame, but for everyone here, you'll notice that we actually are seeing these questions right now. I want you guys to take part in this. All right, so first, we're saying that analysts are encouraged by sound practices to A, customize the risk component titles and descriptions, B, analyze both quantitatively and qualitatively, C, not include every potential risk on the IPS, or D, all of the above. For the people at home, you'll need to choose the Slido answer. For everyone in here, here's where we're going to make sure you guys are awake. If you believe the answer is A, go ahead and stand up or stretch your arms or do something to move around a little bit. All right, no motion. If you believe the answer is B, stand up, stretch your arms, move around, dance. All right? If you believe the answer is C, stretch your arms, dance, move, get up. And how about D, all of the above? All right, I'm seeing lots of motion in here. This is good. And people are awake, right? Because you're actually moving a little bit. So this is good. This is where we want you guys right now. I believe, hopefully, we've given the people at time enough to realize that the correct answer is probably D based on my discussion up here. Anyone who's not putting D should probably be embarrassed by now. All right, so we're going to move on to the next slide at this point.
All right, now that we had that little impromptu dance party. So the next one we're really going to be talking about, and it's one I think I talk about all the time on any presentation that I give, because it is such an important and key role, I think, in the overall analysis process and the exam process, actually, is just the communication that you have within your department. We harp on it a lot. I think it's talked about constantly. And we have seen a lot of improvement, but essentially the main point, specifically when we're talking about communication with the examiner, as analysts, you guys are in that company every single quarter, if not more frequently. You guys are the ones that know so much more on a completely different level than what the examiners do. They're only in there once every 5 years. So the goal, the idea would be that the analysts bring forward when you have that introduction meeting or that kickoff meeting with the examiners, is the analyst is really the one that should be driving a lot of the direction and the focus of those exams. You guys, again, you have a lot more intricate knowledge with the company, so that's what we like to see, is that the analysts are saying, here are some things that I absolutely need you to look at. That's not to say that the examiners aren't going to identify other risks, which is perfectly great and fine to do, because they're also looking at it from a different perspective than you. But the big thing that we would really like to see is that good interaction at the start of the exam, and then during the exam as well. And that doesn't necessarily mean you have to participate on all of the status updates or any of those, but particularly if a quarterly filing comes in and you notice something triggered, or they made some comment in their financial notes to financial statement, that you're not just sitting on that and just putting it in the IPS, but that you're contacting the examiner and saying, hey, FYI, this is what happened, or the quarterlies came in and we didn't have any concerns, or everything was pretty much on track, just that kind of communication. And then at the end is also another big contact point that we really want to see. Not just that the examiner is giving you the information back, but we want to make sure that the risks you gave them at the start of that exam, you're getting feedback from. I think a lot of times as analysts, we're more inside ourselves, I guess, so we're not really comfortable saying, what about this? Why didn't you ask this? But that's really what we hope to see, is that you guys are making sure that what you gave them, you're getting something back in return, and that you understand it. And to the point, like if they were to put, just continue to monitor, well, thank you for telling me how to do my job. So that's some other things. It's like, yeah, I'm always going to monitor their policyholder surplus or their writings. But this is where we want you, like if there is a concern in a certain area and they just say, well, just look at this, or be sure to get X, Y, Z, really understand what they're asking of you and how it's going to impact you, how you can properly monitor it, and what to do with that information once you get that. So that's kind of where this standard is really trying to push everyone to go to, and hopefully it will.
So the next section that we wanted to discuss was sort of what are the differences or kind of the, myths and misunderstandings maybe we've heard between accreditation and peer review. So the first myth that I want to address is, well, peer review and accreditation look at the same things in the file, right? I mean, that's all they care about, is looking at one or the other. And we see this, for instance, when accreditation gets a file and they hear, well, peer review said, or when peer review gets a file and then we find out, Illinois, if you're in here, that it had already been through pre-review and review for accreditation, and then they were submitting it for peer review. Right? So are we looking at the same things? What do you guys think? Let's ask the audience. Are we looking at the same things? I'm seeing a few shaking of no's. I don't see many yeses. So again, moving around, I would like you to put your left arm in the air if you think it is a yes, they're the same. How about your right arm in the air if it's a no? All right, so I see lots of no's, so this is good, right? Because the reality is that these two programs have very different goals and outcomes. One way I like to think of this is that in some ways, accreditation is almost like a slinky that we use as a bar, right? It's all of these little loops kind of stretched out, and states need to exceed that bar. Peer review is looking at a few of those individual links and trying to figure out how to lift them up a little bit. And when we get enough states lifting them up just a little bit more, maybe we promulgate new standards at that point. All right, actually, let me go back. Sarah, did you want to comment on this one at all?
Sure. So I know Topher's already done a really good job. I really like that slinky analogy. I never had thought about that before and thought that was interesting. But as I said at the beginning, you know, the Bible for the review team members is strictly the review team guidelines. So we're not asking you guys to go above and beyond. We're really, it's a baseline set of minimum standards. So the teams come out and look at these files for your work, for your understanding of these companies. And we're really just, again, I can't stress it enough, it's the baseline. So a lot of times in these interviews, you know, I think some team members have this, I can't think of the word now, like a stigma or something, what is that word? Anyhow, a reputation. I can't believe I forgot reputation. But they have a reputation for being hard, or, well, we don't want him on our review or her on our review because they ask really tough questions or they go in really, really deep. Really, they're just trying to get to the heart of how well you understand your company, but when it comes back to bringing that information back and the team goes into their discussions over the actual reviews themselves and what they saw at the department, they bring it back to the standards. So even if you think that the interview might have been tough or you thought, wow, he got so deep into that file I never would have thought, it's not trying to get you or say, ha, you did this wrong. It's just getting an understanding of your level of knowledge and understanding on a company. But again, we're taking it back to the baseline standards when we're all collectively together. And I think that's a big kind of misconception that we get with accreditation reviews. So I definitely kind of want to drive that point home.
I will just offer one more final follow-on comment on this one, which is having sat in on accreditation interviews and having heard the discussion among the accreditation team members, and also having run peer reviews and sat in on the breakout sessions, y'all, the peers, are way more vicious and judgmental of each other than the accreditation team ever is. Don't fear the accreditation team. They're very cuddly. They're going to come in and try and help you. It's the peers that get scary sometimes. All right, so myth 2 is and one where I'm definitely going to want to get input from Ed and Michelle. And this is sort of the things that maybe the accreditation hears that they have said or hears that the peer review program has said or what the states worry about. So, Michelle, when you have somebody coming back from a peer review or you have somebody coming out of accreditation interviews and you hear, oh, well, you know, accreditation said or peer review said, how do you take that input? How do you think about that?
I will use my judgment. Don't just take the face value, you know, because we know our companies, we know our laws and regulations better. We monitor the companies for years. So we don't feel offended, of course. You know, we really treasure all the feedback that we can get, whether from peer review or the accreditation program. When we receive that kind of feedback, after people come back from peer review, we actually schedule sessions with them. We call workshops. So we discuss among ourselves, like go through each feedback to decide whether, you know, which one is more relevant, which one we can apply, and which one we decided to put a pause on it, right? For accreditation, same thing. We have, after the pre-accreditation review, we have our group discussion. The entire division, my entire team, we went over every single feedback, you know, from those individual interviews. And then we talk about it, share, you know, trying to develop what we need to do to improve our process better. Sometimes when people will say, hey, the peer review told me that we have to complete all the supplemental checklists, or we have to use the NAIC quarterly procedures. Not necessarily true. What we did is we incorporated all the supplemental checklists, most of them, into our annual review procedures. So we take the key ingredients, the components, and put in the raw, our procedures into different sections, because we believe we prefer to have one document, one shop, for you to see everything, if possible. Same thing for quarterly procedures, right? We ask our analysts to download them as a reference guide. Pay attention to the key risks, reflected in the procedures the one that we downloaded from iSight. But at the same time, we allow our team members to use their annual review procedures to carry that forward and to provide the quarterly updates to the annual RAW. And also that way we'll give them a chance to clean up certain sections, update certain sections, for example, business summary or holding company impact on their insurers, or even supervisory plan throughout the quarterlies. So by the time when they work on the annual, that will be an easy transition. So annual, they will have more time to focus more on the risk assessment itself.
Thank you, Michelle. And Ed, how about as a team member? What kind of things have you heard that the team has told people and that's why they do things, or that peer review has told people and that's why they do things?
Yeah, so when I see analysts and we're talking accreditation, the very first thing they say is, look what you made me do. Okay, yeah.
He's working those Taylor references.
Hard hands, yeah, hard hands. Okay. No, seriously though, just a tiny bit of history. I do want to leave time for people. This is a great topic. We could go all day on this one. And I want people to ask, I heard we have to do such and such, and I'd love to hear some. There's other team members in the crowd that would love to answer some of these too. But where this all kind of starts from is when we started the program in the early 90s, literally all we had were standards, and they were very general. And the F committee at the time said, hey, accreditation team, we want you to go out there and figure out what we're supposed to do. And that's really what it was. And a couple of things made it clear how much influence we had and how careful we had to be. One was, one of the first states accredited was South Carolina. And one of the things the team found a very good tool was they had a nice analysis checklist system. And as we started going to the other states, we could see it was identical. And we'd hear the analysts say, well, yeah, the accreditation says we have to do these. And another one was, sign-offs. It got around that the team was saying you had to sign off on every page of every document. So we would literally get annual statements where every page was signed off. Seriously. I mean, and accreditation said we had to do this. So, as an approach to that, we developed the guidelines and interlineations to try to help. But as team members, we try to be very cautious about what we say in our interviews, in our meetings with the department during the reviews, because we don't want that impression. Just some silly examples that mainly what I hear today is documentation. Documentation is the big one. But they're as silly as things as, we'll look at the IPS and we'll see there's a different color on the next quarter, and we'll say, we really like this. We like this. And we'll go into the next meeting and the supervisor will go, we know, we're supposed to do colors, so we'll do colors from now on. And it's like, no. It's not an accreditation requirement. Listen to what, if it's unclear what we're saying, make sure you ask questions. The biggest one is how detailed does the documentation have to be? And I touched on one earlier. For instance, supplemental checklists. If you're an experienced analyst, I hear this everywhere I go. We have to do the supplemental checklist. Well, not for accreditation, you don't. Now, your department might require them, and we're not discouraging. In fact, we encourage it for many analysts, especially those that have less experience. But if if you've been in the game 10 years as an analyst and your supervisor's been in the game for 25 years, I think you know what to look at when you look at a CPA audit. You don't need is it a contractor? How many years? You just don't need that. So you can document it in a different way. In addition, in the risk assessment worksheet itself, every risk doesn't need 6 paragraphs. That's not what we're encouraging. What we're encouraging you to do is make sure you document in a concise way the risk, the work you've done, and maybe mitigating strategies. And keep it short, keep it simple, but make it reflective of what you do. Because again, I literally have heard this when I say, Ed Dinkle wants us to do 20-page IPSs and 50-page RAWs. And that is absolutely untrue.
In many colors as well.
Yeah, in many colors, right. So I think now is we're in the world of documentation. We have so much to do. So that's the area. Use Topher, use Sarah to clarify that thing, because we have so much to do that we don't need to be wasting our time on documentation.
And I will say, that oftentimes you'll hear teams, if you've ever sit in on an F committee meeting and we provide what's called positive attributes. I want to be clear exactly what those are. Positive attributes don't necessarily mean something that is the greatest of all time. Positive attributes kind of takes, okay, all the team members, we're typically seeing this being done at the state, and it might be below the standard. And so if we see even another state that's like actually meeting the standard, that might actually be a positive attribute. So when we do provide positive attributes, we've actually kind of scaled back on them, because states are getting the impression that, oh, well, we have to do that now because this state got the good thumbs up on it, so now we have to do it. So we're really trying to make sure that the positive attributes that are identified are those positive attributes that pretty much any state could adapt to and bring up their process a little bit more. So it's kind of a way of starting to raise that bar a little bit better, and just really, it's not a requirement, but it's something that we thought that state does an extremely good job on, and if other states were to do something similar, it might actually elevate their analysis as well. So those are kind of how the positive attributes come around, but they're not a requirement, like documenting in multicolors, any of that. But just wanted to clarify that as well.
All right, so once again, we're having a Slido question for the people at home, but for you guys, right, given what we've just said, if an accreditation team member or a peer review letter comes back to you and suggests that maybe you should think about something, is that a 100% requirement that you must do it and it applies to every single state in all cases? What do you guys think? If you think it's yes, hand up. If you think it's no, shake it off, dance around. All right, good. So it looks like most people in the audience here understand that the correct answer should be false. Again, for anyone playing at home, you'll notice that I'm sitting up here saying that the correct answer should be false. So hopefully everyone is able to go and get, oh, good, I got the correct answer. CE, it's not about getting the questions right, it's about getting the questions completed. All right, so at this point in time, normally we would have jumped in and talked about, kind of what other things maybe have you heard. But at this point, we're getting, a little bit closer to the end of time. And so I think instead it's a little bit more important for us to spend, a few moments here talking about where can you go from here? What kind of things should you be thinking about? All right, so first, you'll notice in the fake disagreement really that I set up with Ed and I, that there are some shades of gray. And the amount that we can cover and get into those details in a 50-minute period is extraordinarily limited. And so if you want to know more in terms of the best practices, those are available out on StateNet. For analysis, they're up on the financial analysis StateNet page. They're right at the top. They're about 8 lines down. And you'll see both the IPS sound practices and the risk-focused analysis sound practices. Both of them are set up with applies and avoids to give you some idea of, okay, we should do these things maybe, we should do those things maybe avoid these other ones. And you'll notice I used a lot of maybes in there, right? Because one of the big takeaways I want all of you to take from this is, hey, engage your brain. Think about what makes the most sense. Talk to colleagues and ask them, hey, if I say this, does that make sense to you? Do you understand that? Even better, send a quick email to a colleague in a different state who does things differently and say, hey, if I put this in an IPS, would you understand that? And that will give you some ideas of maybe where to go with this. So one last Slido question for the people at home. I'm not going to actually make you guys dance or anything else, so you have been spared from that one as we are coming a little bit close on the time here. But what I would like you guys to take from this is that accreditation and peer review are both going back to something that our keynote speaker talked about on Monday, and that is trying to use everybody to help the team complete things, to lift everybody up, right? You know, in Mike Massimo's talk, he talked about how, you know, with the swimmers, the weak swimmers and the strong swimmers worked together, and nobody got out of the pool until everyone was done. Similarly with financial analysis, right? We all depend on one another, right? So we all need everybody else to have good, high-quality work, and so we owe them good, high-quality work in turn. All right, if you have other questions, Sarah Franson is the accreditation team, or excuse me, the accreditation program manager. I am the accreditation and exam specialist. I had to think it's such a long title. Ed Dinkle is part of the accreditation team, and Michelle Lowe is joining us from the department in California. So thank all of you very much for your time and attention. We really appreciate it, and we hope you've enjoyed the conference.